The market continues to show signs that this breakout's going to hold and continue to start this run, intermediate run to the upside. We're going to break down those increasingly bullish signs, especially some of the red flags that we had seen previously being lowered and replaced with some green flags. So we'll break those patterns down. We'll also talk about the rotations that are going on and how that impacts this expectations for risk appetite going forward from here. And today's trade idea takes a look at a stock like the broader market showing signs of a breakout as well. So let's go ahead and get started. Today is Wednesday, September the 11th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, as always, let's start off taking a look at the S&P 500 with the market forecast indicator. You notice the rate of change numbers are improving on the S&P. We'll get to that here in just a second. Just kind of looking at the green across the board, still up almost 20% year to date. But getting a nice little breakout of today of this little sideways action we had post breakout and back above this Fibonacci retracement zone and closing above 3,000. It's kind of a significantly round number, only significant for that. No other technical reason right now or area in that spot. If you look at, you see the moving average is heading down, 29.16 yesterday, 48 to 29.16.07. So it will actually still be yellow tomorrow based on that. But look at we finished at the high of the day, so the momentum line was at 100, not surprising. The near term line finished at 84, still lower than its previous peak here. But look at the intermediate line, 79.12. So we were essentially 0.8 of a percentage point percentile from finishing with an overbought cluster. To get an overbought cluster is not a very common thing to begin with, and especially getting one at the beginning of an intermediate trend is very positive. One little thing that stands out that going back 20 years that we haven't seen before, and that is this would be the first time we've had an oversold cluster with a falling moving average. That's how significant this move has been over the last 2 weeks to go from this 2870 area all the way up to 3,000, 130 points in that amount of time. With a breakout last Thursday, first of all, it's kind of breakout move that we had on the 29th, and then a sideways action, breakout move on Thursday, and a sideways action, and so far as of right now, breaking out to the upside. So, obviously we have the dark green shading. We don't have the green line yet because that's what the rising moving average is. We're already trading above, so it's probably only, if it's not going to show up tomorrow because we're still headed down today. Obviously it will show up. Most likely on Friday. You'll get that depending upon how we finish tomorrow. Most likely will show up on Friday. So then we'll have our bullish pattern, like that bullish, dark green shading green line that you see over here. And again, it'd be, it would most likely also coincide with the Russell 2000 giving us dark green shading and potentially a green line. You can see we're still dropping barely from 1504 yesterday to 1503.85. So, but most likely it will also turn up. So here we were a week ago saying, one of the concerns about this new intermediate run on the S&P is we're not getting the Russell to join it. At worst, you want the Russell to kind of come in and hit that bullish pattern at about the same time, if not beforehand. You want it to be first. And it was lagging until last Thursday. It was significantly lagging. And then even on Thursday's breakout, it still hadn't come up above its highs and still hadn't got above that moving average yet. And its intermediate posture was way down. But 3 consecutive days here at the top end of this chart later. In fact, you can see if I were to customize this chart and just go back 3 days instead of 63, then you can see the rally in the S&P and the IWM up almost 5% in just 3 days alone. And you can see on the other end of the spectrum, you have mid-cap stocks also performing pretty well. The S&P is only up, 0.75% in that same 3-day move. Most of those gains coming today. On the other end of the spectrum, you can see bonds And you can see also the VIX was up until today. Today's drop about 4% finally gave it a loss. It was actually up for these couple of days slightly. And again, gold is your other risk trade, safety trade that's been so bullish. It's down, but it's down about as much as the S&P. It's not down 4%. So you can see the market's kind of, there's your value dividend stocks, and value stocks are also having a good 3-day run too. In fact, even your international stocks are outpacing the S&P over this 3-day period. If I were to go back and include actually since the breakout, when we're really getting this rotation into out of safety and out of what has been working and into the more value areas, stuff that has been more beaten up. Again, you can see this includes this Thursday gap. Now you have small caps, mid caps. Small caps up almost 6%. There's your S&P. Small caps outpacing the S&P 3 times, doubling what you're seeing in the Dow Jones. There's your value stocks, way outpacing growth stocks. So growth has been struggling behind. And then there's gold and TLT during this breakout, and the volatility index being down 15% total in these 5 days. So again, aggressive rotation out of safe haven asset classes into risk trade, into the risk trade, really into the risk trade. The one thing that's a little bit of a concern, and that is crude oil kind of not joining. But regardless, you've got, look at the near-term line with yesterday's move getting strong in the upper reversal zone. It's well established up there. Obviously, the intermediate line is making its run. The momentum line didn't quite get that extreme peak. It did over here. That was kind of our first sign that we would make. In fact, off of that cluster, that would include, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This would be 10 days if I were to go back and customize this for the 10 days. And actually be the close of the 11th day, wouldn't it? Well, let's just go back 10 days and try to keep it consistent with what we've been seeing here. Oops. So here's off of this cluster, you can see we're up about 8%, and you can look at crude oil only up about 2.25%, really lagging behind, and a lot of that's coming in the last couple of days. But still, coming off that cluster, you get the extreme high, you get the near-term line giving us a bullish low point here, and then now the strong bullish peak. So again, a few days ago we were thinking, we're probably not going to get the start of this intermediate run right now, just because the Russell 2000 was so far behind, and that we don't like to see that. Now the Russell 2000, in a matter of 3 days, has caught up significantly to the point where you probably won't get it tomorrow, but barring how big of a, if we were to pull back tomorrow, how big of a pullback it would be. Most likely by Friday going into the weekend, we will have the bullish combination. In this case, you would also have a rising market sentiment line, still below 50, but you don't have the rising market sentiment line here. The Dow Jones Industrial Average looks very similar, crossing up above 27,000. Again, very, very close. The near-term line is the one that got to 100 here. The momentum really close to 1. And then the even higher up on the intermediate line there, and then your Nasdaq has been lagging, so its intermediate line is not quite up to the 80 level. Your near-term line, momentum line getting to 100, and your near-term line barely getting above 80. Again, kind of setting up like the S&P the potential of a bearish divergence, unless the near-term line it's got a much better chance of getting above that high, because that the previous high is not so high, and even the S&P's got a decent chance of getting above that high too, and kind of erasing that divergence potential. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells me two things. Number one, you got something out of our video today. Number two, that you want us to do the video again tomorrow. So a quick way to give us feedback. You can do that right now while you're watching. Again, if that's if you want us to keep doing these videos, and it's one click lets us know down there at the bottom. Of course, while you're down there, comment. What did you get out of the video today? Anything stand out to you? Let us know. Join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook community, that we've created on Facebook. All right, if you're watching this on our blog, here in the blog post, you can see we have a link to today's Market Outlook live video that we posted that always takes place every day at 3:30 Eastern. We review all the trades that we've made in previous Market Outlook videos. One of the trades we actually closed out today, so you can check that out by going to this link, top right corner. It's also, if you mouse over Trading Rooms, it's right here. There's a link to the Market Outlook Live. There's the page and what it looks like, and all the archives are down below. Again, this is for Plus subscribers, but you do get or premium. Premium subscribers, of course, get access to everything that we offer. But Plus subscribers are a monthly subscription plan. You actually do get a 30-day trial to that. So click on that link. That gets you access to these videos too. So if you want to check those out every day that I do the Market Outlook, for now at least, subscribe to that plan and go to that link. We also invite you to engage with us on social media here. It looks like we almost got to 100 likes. Again, the more you engage with us on these platforms, the more likely they are to continue to push our content to the top of your timeline. Again, as I mentioned before, probably about 25-30% of my followers see my stuff on Twitter, and that's an even smaller number on Facebook. So to make sure that you see everything, just click on that heart and it opens up a new window like that, and you can click like. Same thing with Facebook. If you click this image here, it will take you to your Facebook page. All right, if you take a look at the long-term charts, look at that nice, good bullish Hakinyashi candle here, coming a couple weeks after this. So, and it's holding up. Like, again, the concern was this reversal in the long upper shadow on this first Hakinyashi. It's, a lot of times they just don't play out. They usually give way to maybe another transition candle or two. And as of right now, it's holding out really well, which is a good sign for this move to hold. You can see we're above a rising 50-day moving average, or 50-day moving average is above a rising 200-day moving average. The PPO is actually relatively low. You can see, again, back on this chart, if I were to go, let's say, out to like a 20-year chart, you see where my cursor is. If you look all across there, there's a lot of times the PPO is actually higher than where we're at right now. So we're definitely not at an extreme in the least bit for the long-term momentum. If you take a look at the 3 green arrow charts, we obviously have 3 green arrows now. We don't have the rising moving average yet. That's the bullish combination you like to see on this chart. But if you look at those 3 green arrows, you can see the MACD is easily above. The stochastics is up there. In fact, the moving average for the stochastics. I mentioned over here that getting the orange line above 0 is a significant thing, because that's the sign that we're getting the intermediate rally. We didn't get that over here on these two kind of fake outs, and we are now. So very positive development for a continued bullish move on there. And you can see the stochastics. Again, the 5-day average of the blue line is easily up here as well. Little concern again that this might be the end of the run. The end of the surge. That doesn't mean that we're going to go down. You can see the end of the surge occurred here, and we still moved higher. This was just that first surge, and then we just slow down as we go, and we divert. I mean, that's how it always is on any intermediate rally. And so this divergence, we didn't get quite the gap up on the MACD as we have seen on others. So, like this was a big move higher. Here was a big move to the upside when that intermediate run started. This one's a smaller kind of surge, and we'll see how long that one lasts. This one only lasted a little bit more than a month, so that's a little bit of a concern from that standpoint. But good sign. The 8 and 17-day rising, we're still above the 8-day moving average. Even yesterday's little pullback, even on the intraday basis, didn't get below the 8-day moving average, and so we continue to ride that higher. If you take a look at the intraday chart here, let's see, right here, You can see, we kind of broke through to a new 4-week high today. The 4-week high was over here. Now we're up. We got about an 18-point gap here. Again, we never really stretched out that rubber band to the downside because we had a pretty tight range here on this pullback. Now we have about an 18-point gap. That's over 5% of the range here. And usually we start off intermediate runs with pretty high ranges because they started out so high. We're coming off significant lows. We move on through. But because we were so tight for a while here, with essentially the 4-week range being about 11 points, again, we pushed already up to more than 5%, just like that, from well below. Usually we kind of start off around that 10% mark, and then compress as we move to the upside, as we grind our way to the upside, and then you kind of have a late bullishness expansion. You kind of 5% seems to be like the upper end before the low starts to move up. It doesn't mean that we're done. It just means that we start to close in and just kind of slow down again after this initial surge in momentum. If you take a look at the daily chart here, give me 1 second here. Let's see here. And actually, we need to go over to this chart, and then we'll look at SPY. You can see the volume picked up at the end here with about 68 million, so just about at the average. And the range, there are no gaps, so the range was 2.5 points below that. You can see we're kind of riding this Fibonacci fan. A good breakout of this fan will really get us going to the upside. Otherwise, we might pull back into this area on any near-term pullbacks, right? We're not talking about any kind of drops, but any kind of near-term pullbacks, look for a move back down to this Fibonacci fan level where my cursor is at. But if I put that range and volume into context here, you can see we're really getting really close to crossing below 1%. That's when we're on our move, right? And we kind of just grind away for however many months, potentially into the end of this year. So we're looking like for about a 4-month rally potentially coming out of this. If not, there might be if there is an intermediate pullback anytime in that 4 months, then we'll probably get a couple in 1-2 month intermediate runs with that pullback in between. But for the most part, we should be pretty bullish into the end of the year. And then after that, going into next year, that's the big concern, since the market sentiment rally started pretty much at the beginning of this year. The likelihood of a market sentiment pullback at the beginning of next year is increases in probability. You can see the range at 2.5 points, so well down here, bringing the average down. The volume was at 68 million, also a little bit below the average, bringing the average down. That's all perfectly normal. Volatility, it kind of broke below 15, and it's not really holding. As I mentioned previously, that all these other times that we've broken below the 90% mark on these intermediate runs, we've also broken below 15. And we can go back and see plenty of examples of that. And this is like one of the first times that we've broken below 90, but we haven't broken below 15. So, again, one of those signs that the market's still a little skittish. And, of course, we got the European Central Bank tomorrow, and you've got the Fed next week and what they could do. That might be keeping volatility elevated at levels that normally would be a lot lower, considering where we are here. And we are down to the midpoint of the bullish range, which is the 85% mark. Lately, that's been an oversold level. That's typically not your oversold level. The 80% mark has been the oversold level previously. If I go back a little bit further, you can see the 80% mark tends to be that lower level. But as of right now, the 80% has been kind of acting as, or 85%. Over here, you can see we really got, in 2017, we were really below the 85 mark quite a bit and used the 80 level as the oversold condition. So keep that in mind. And, we're not, I'm not, again, anticipating a tremendous pullback, but considering the run we've had in the short term and chasing a big run, 8% move in however many days that's been, 8, what do we say? How many days was that to get to this run? 10 days to get an 8% move, usually these fast moves, it's, they don't, they're, I'm not saying that they'll completely reverse, but it's hard to keep up, right? And a lot of times we end up chasing something only to have it pull back on us before it really gets going and gets into a sustained, because what you want is a sustained grinding move to the upside. It's boring and it's hard to make directional trades on that, but it's easier for your more high probability type strategy setups. So just to summarize our market, our technical outlook, the signs of this intermediate run starting now, rather than a little bit later, which is kind of what I was expecting, are really starting to ramp up. Now, that doesn't mean that we might not get a near-term pullback, right? Getting the blue line below, but seeing the Russell 2000 catch up, the volatility not really dropping yet where we want it to, but seeing the trading ranges drop and getting through some highs and some levels has really kind of changed things in the past few days, a strong rotation. Now, one other kind of red flag factor is the fact that our correlations still aren't, they're already really low. And it's, generally speaking, you want an intermediate rally to take you from high correlations to low by the end of it. And here we are starting an intermediate rally with correlations that are already low, which means for them to get high again, and then turn back around and get low at the end of a run, we need one of two things to happen. Either utilities and real estate to stay strong while these other areas move up to the upside, or for everything to pull back a little bit, and then we move up to the upside. So I was kind of in that latter camp originally, and it very well could be the former that ends up playing out with the strong rotations into these kind of these beaten up areas out of the strong areas. But then you see some like utilities, for example, today kind of rebounding and bouncing back up to the upside. Not so much real estate, but utilities. So it looks like it might be the former, where this is the beginning of the intermediate rally. Small caps have caught up, and away we go. Again, not that we're going to shoot off to the moon, but here we go on this slow grind to the upside, which from a trend trading perspective is exactly what we want to see. So what do you think? Do you agree with that assessment? Do you disagree? Click that poll that's popping out, or click that link right there. It's popping out. It opens up a poll, and then either click agree or disagree. Of course, if you click disagree, as always, comment down below on what you're seeing that suggests maybe you're not so bullish as what we're coming up with here, and that we should be a lot more cautious for whatever reason, and then share that reason and what you're seeing with us down in the comment section below. All right, now let's take a look at what's driving this price action. And as I showed you here in this earlier today, crude oil actually peaked early yesterday morning. This is the breakout, right? This chart is starting on the breakout on Thursday, and since then we've really rallied. And a lot of this rally, even with a little bit of a drop in crude oil last Thursday, but a lot of this rally has been because of this rise in risk appetite. Crude oil went from 2% down to over 4%, but then it's dropped. It's been down more than 5%, about 5% here from that peak early. And you can see from that time, the other risk asset classes have diverged. Small cap stocks really have taken off, even with crude oil dropping. And it's not like we're having this big drop in commodities, because agricultural prices all rallied with the news from China that they'll be buying agricultural products from the U.S. And so they've really taken off, even if crude oil has dropped. And you can also see, too, that the dollar has actually risen during this time frame. And despite that, gold has been relatively flat from that period. And you can see long-term bonds have fallen off as stocks have rallied. So it's been a little bit of a risk-on move, except for one of the most, the highest beta risk plays is not participating. If you take a look at its chart here, the crude oil chart, you can see that, we've got, here's the crude oil move. This is today, it's just starting. But you can see we have, light green shade or light pink shading. We actually have a yellow line here because the moving average is falling. We are above it, but it's falling. So that's why you have the yellow line and light pink shading. So we'll see if it ends up holding here for support, and then we rally through and then get going to the upside along with equities. But you notice, generally speaking, crude oil has a pretty decent relationship with equities. In fact, here, let's get rid of all of these and then just put on a comparison chart of SPX, which you can see right there. And you can see how they've kind of moved together. Not surprising. They go up together, they come down together. And then they went up here and then down, and then the S&P went up to a much higher high point, and crude oil didn't. In fact, the S&P went up to a higher high here as well, and crude oil didn't participate this go around. And they got even a lower high here, and as of right now, it's not even close to getting up to that same high. A little bit of a head and shoulders top forming here on the S&P 500 when you look at it from this perspective. Obviously, we'll see if that ends, how that plays out or not. Keep that pattern in mind, because not a lot of people are talking about that pattern. In fact, I just barely have seen this pattern for the first time, just looking at it in this way. We've had this divergence with crude oil. If risk appetite is going to take off, crude oil generally has to take off along with it, and we just don't see that pattern yet developing. You can see what the weekly chart looks like. Lots of long upper shadows on crude lately. The bears are really trying to figure this out. The bulls and the bears trying to figure this out, and at least there's an upward climb to this. But you can see we're not taking off. For a while the Russell kind of showed the same pattern, though the Russell, like I said, in the last 3 days has definitely caught up to the upside. Let's take a look at the dollar index. It's another kind of key element. And you can see today the dollar index has taken off sharply to the upside. So it had a little pullback. It got its own light pink shading, yellow line. Has since bounced like it did the last 2 times. We got the same pattern. We have since bounced, and we're moving back up, easily above 98 and continuing that trend. Interestingly enough, a rising dollar is not too bullish for small cap stocks. It's generally like, for example, back in the late 90s when you had a good run on the dollar because of the wide spread between U.S. yields and European yields, that led to a big run on the dollar back in the late 90s. Large cap stocks actually did much better, and it's very similar to what we're seeing now, where you have big names at big market caps that are leading. Not leading the last few days, but for the most part, generally leading the way. In fact, I saw a graphic today that showed was the Apple, Microsoft, again at $1 trillion market cap, and that wasn't a bullish sign last time we hit. Now, of course, we'll see what happens, but the last time that was generally kind of a top for their market caps to hit such a significant level for those two. And again, that's kind of what we saw in the late 90s, where you had some large cap stocks really take hold and get going, big names that kind of led us, again, for multiple years to the upside before it finally ran out of gas. Let's take a look at the yield. That's the other big story. And you can see, again, similar to what we see in the S&P, but this is a little bit more stark. You have light green shading where we have a bullish pattern. We have the highest near-term line that we've result that we've had since way over here. But that was bullish for a little while before it found the top there and just kind of was grinding down. If I were to take a look at here, let's edit the properties here and bring up the bigger Fibonacci retracement zone. Right, the smaller retracement zone is right here in the middle with these solid lines. The midpoint actually is just a midpoint. That's not really a Fibonacci line, but there's your smaller Fibonacci retracement zone. Here's the bigger one, and you notice we're not even to the top end of that yet. So, we're not anywhere close to any kind of recovery in yields. It's been a nice week. We had a bullish engulfing last week. It's been a nice week so far, but you see, where and how far we can get up to. If you look at the Bollinger Bands for TLT, we'll look at IEF for a while in a minute here. You can see how far it can drop before finding some significant support. Little supports in these areas, but before finding significant support. You look at IEF, look how much it can drop still before it gets down to 110, which would be its equivalent area. And that's probably going to end up being what we're looking for to get up towards this the bottom of this the normal Fibonacci retracement zone between 38 and 62%. Now, as I mentioned to you before with the sector strength, interestingly enough, you'll notice that if I go back to the sector comparison here, and again look at from September the 5th, since Thursday's breakout up till now, you can see our clear winners are the biggest losers that we had previously. You have energy, financials, energy down off their highs. Remember, the crude oil peaked here, so energy is not nearly as down as much as the actual crude oil itself is, simply because there's still a lot of momentum into these quote-unquote value plays. Financials also rallying significantly. Industrials making a run up to the upside too. Whereas back here you have technology, discretionary, communication services, your more cyclical areas, as well as materials, your other dollar-sensitive area, doing so well. Again, that would be pressured by a rising dollar if it continues the trend to the upside. And your biggest winners are down. In fact, interestingly enough, utilities rallied here today, and staples has been relatively stronger than those two, but real estate still staying at its lows that we hit last. So again, from Tuesday when crude oil peaked, this is right about when crude oil peaked right here. You can see real estate's flat, utilities is up, staples is up, energy stocks are down. It's actually probably more right in this area. Financials are up a little bit, industrials are up, communication services slightly up, discretionary is up, technology is up a lot, healthcare is up a lot after some struggles going into, and then of course, well, that's all of them. There's your all your cyclical areas kind of right there. Materials kind of up a little bit too. So that's since crude oil peaked and rolled over. If you take a look at the 12 grid for crude oil, or for these sectors here, again, you can see these are the three biggest winners. And down here you had financials, industrials, and energy, kind of your biggest losers. Look at industrials, again, getting that cluster with that moving average still yellow there. That's not a very common sight. And you can see these safe havens are all pulling down. Utilities really bouncing up today. And that's why I say, okay, there's two ways these correlations can get back to being strongly positive before making a run back down to the downside like normal. And that second way of these staying strong and bouncing up and moving up along with the rest of them appears to be what we're seeing at least today in utilities, kind of showing us what might happen here in real estate with the move down to its low point, and what might happen with staples, as it looks like it might be trying to form a low point in this area, and everything else turning around these moving averages. If you take a look from a foreign perspective and see how these big economies and how they're working out relative to the S&P 500, you can see how they're doing. Again, these are all a weekly chart. See how bullish the S&P is, and China is really kind of bouncing up, and Japan bouncing up, and they're all bouncing up towards their moving averages. UK bouncing up, and France back above a rising moving average. Same with Italy. Russia bouncing up off of its long-term moving average. Canada as well. So we're getting some nice little rallies across the board. When you look at it on the smaller time frame chart, look at the rally some of these had. Look at Japan, the big run it's had. Germany making a run back above its moving average. Strong intermediate lines. Japan's got the biggest one here. China kind of lagging behind, still got a yellow moving average. UK also lagging behind in the 50, and India really kind of lagging behind. Italy is up, strong intermediate posture, rising moving average now. France also got a rising moving average. Look at Canada getting, probably like Japan, really close to or did get a cluster. I would venture to guess Russia and Japan are close. Russia is still not quite up above 80 yet. And then look at Korea also taking a rally to the upside. Those two kind of linked together through their own trade issues. And Brazil, like India, lagging behind a little bit. Those two have the weakest intermediate lines out of all of them. So for our trade idea of the day, I want to take a look at Tesla, actually. Tesla's got the bullish pattern here. It's got the rising market sentiment line above 50. It's got the intermediate line crossing up above 50, crossing above its market sentiment line, no less. And you got a rising moving average. It will turn green tomorrow because it is higher than it was yesterday. And we're easily up above. In fact, we're up above all these highs. Good little kind of breakout move here. If you were to take a look at its 5-year chart, you can see it's kind of trying to get up. We had this low point. We got to the moving average. We hit it. We got to a higher low. And now looking like we might break this moving average and run up through to the upside. Its moving average also turning up. Obviously, we don't have the dark green shading or the green line here yet. If you take a look at the long-term view, the weekly chart that we look at for Tesla, again, the same kind of pattern here. Nice, good bullish transition candles, a couple of them. Then a bullish candle here, meaning that we could get some bullishness over the next so many weeks. You can also see the PPO, the long-term momentum. So it's like the MACD on a relative basis. You see how low, it's been pretty low. This is a pretty low level. You can see it's already, even now it's still pretty darn low compared to where it's been in the past, compared to all these other lows that we've had some good runs. So there's an opportunity for a decent rally to come out of Tesla here to the upside. Of course, in the short term, you got that earnings coming up, and you also have some levels of resistance. You can see right in this area that we are clearing the volume node, the point of control, excuse me. So that's, but you still have most of this value area still up above us. Lots of volume above until you really get above through here, this 315 area, 308, 315. Then it can really get going to the upside. And, we're still not, we've got a lot of headwinds. The nice thing is we got some really strong support below us, more volume below us than we have above us with these smaller nodes up here. So that's a good sign. And then also the other really positive sign from a breakout perspective is the DMI has the pattern you like to see, the above 25 on the blue line, below 20 on the orange line. But you also have the blue line also getting up above 30 even. And even really close to 35. So that's a good sign that we're this is a good start to a run. And it's not just kind of you can see how we never really did get going on the orange line. We got above 30, but we never really got going to the downside, with a strong move, not like we had on some of these other areas, even back here where things really started to break down and you had a good strong move, up above on that first surge to the downside, bounce back, and then we started to trend lower. So that's the pattern you like to see. It's a good start to a run on the DMI. Of course, when you look at the 3 green arrows and the 2-line versions of those, not only are we getting 3 green arrows with a spike in volume, no less, but we're also, the MACD is rising above 0. The MACD is still growing. The stochastics is up in the reversal zone. The orange line's barely crossing above 0. The orange line hasn't gotten to the reversal zone yet here. The 8 and 17 are crossing up above the 30. All good signs. So a good opportunity for a bullish trade. Again, we already put this trade on in our Market Outlook Live today. And so what we're going to look at is selling a put option. So not being too aggressive on a directional trades, but selling the 230 put. It was a little bit higher delta when we first got into it, and then buying the 225 put. I think we ended up getting in at about $1.32, $1.30 in that area. So depending upon where you get filled in at, it's a relatively wide spread because it's an expensive stock, and you need to at least get $1.16 to make to get the 30% return on risk, which makes the risk worth the trade. But you can see 230 would be below that Bollinger Band and really set us up for some strong, not the Bollinger Band itself, excuse me, but the point of control on the volume profile. It's very, very strong support of that 230 that would help lift it up. All right, well, that does it for today. Again, you've heard from me. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. Takes you to our Market Outlook forums on marketscholars.com. Again, all you have to do is be a free subscriber to participate in those forums, but open up any new thread there with any questions or comments you have about anything we discussed in today's video or anything we didn't discuss that pertains to what we're talking about. And of course, you can always reply to anybody else's new threads, anybody else's thread as well. Thank you again for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down below. Follow me on Twitter for more content in between the videos, and join our community at marketscholars.com as well as on Facebook. With that being said, again, have a great rest of your evening, everybody, and we'll see you all tomorrow.